I am going to briefly talk about the economy as it relates to the capital markets. We're not very optimistic like Drew on the U.S. economy, but I thought I'd start off by putting everything else in perspective, and that is, these are the news that was going on 2 years ago, which as I call was a September to remember. And I actually have September 16th, 2008 Wall Street Journal here. And the only news that day was that Merrill Lynch was bought by Bank of America, Lehman went under, and AIG was on the verge. And so you can just see it was really, it was a lifetime of business news in 1 month. And what that doesn't have on it, actually September 29th, the market was down 778 points that day. So while I'm not real optimistic today, it feels a whole lot better than it did 2 years ago in September. And the only good thing about Ike that came through is that we actually didn't get to read the newspapers every day. So I got this about a month later, and it reads like a horror story. But anyway, onto our views of the economy, and quickly. We do believe in what a lot of people call the new normal. We think a lot of this is structural versus cyclical. I think Drew outlined a lot of the reasons why, and I'll talk a little bit about that. We think unemployment will last for a long time, and we think we're in a deleveraging the economy process. The traditional tools to get the economy going are either fiscal stimulus or lower interest rates, and those have already both been used to keep the economy from going in the tank. So those won't be not available. You got demographics, so you got an aging population on top of that, and then you got higher taxes, healthcare costs, and re-regulation. So a lot of headwinds for the U.S. economy. Relative to some industries, we think the consumer is really in a jam. But I do say the one company that seems to defy all odds is Apple. I got an iPod the other day, and it's the most amazing toy I've ever seen. So we do think global growth will offset the U.S. economy to some extent, and there are lots of industries that are doing well in this environment. And some of those, as you can see, include business services, energy, infrastructure, technology, and healthcare. And Texas is the place to be. We really are somewhat insulated from the rest of the country for all sorts of reasons. We do think the world really was in paralysis between October of '08 and last year, mid-'09, and we think investors and lenders were waiting for the economy to bottom out or stabilize, and we think we're in that process now. We saw deals and money start to get spent in late '09 and earlier this year. And actually the M&A market is fairly robust, which we'll talk about in a couple minutes. Strategics have to make acquisitions to offset organic growth. There is a lot of private equity, which we'll talk about also. And there's a lot of baby boomers out there who are going to want liquidity for their business. There's a statistic running around that there are 5 million businesses that are private between 5 and 500 million, and 80% of them were born between 1946 and 1964. So a lot of baby boomers hitting the 60, 65-year-old that want to sell their businesses. And one of the themes today will be smaller transactions are actually easier to get done. I've been doing this for 28 years, and every year they say bigger is better. In the last couple of years, actually smaller is better, which is really what I call the lower middle market, which is representative of a lot of the companies here. Page 7 is the risk spread, just quickly on whether the financial markets have stabilized. And really, if you look at the light green line, that is the spread between 3-month treasuries and LIBOR. And right now, it's back to where it was historically, but you can see that huge spike. That huge spike was exactly when this newspaper came out, when there actually was concerns whether the financial system would go under. So certainly the financial system is stabilized. The next page is a little bit what Drew talked about, and that is this, I think you can make a case we've been in a boom for 30 years relative to leverage, both with the government and consumers. And I think if it takes 30 years to create something, it takes more than a couple to fix it. And so this year you have, the blue one is government spending, which Drew talked about, and the red one is a percentage of disposable income. So the consumer has been over-leveraging for a long time. I was thinking about this weekend, and I decided to call my mom. And my mom was born in 1925. She was a radar operator in World War II in London, and she turned 85 Saturday, so she's been through a lot in life. And I said, Mom, when did you first get a credit card? She thought about it. She says, David, I'm not really sure. Let me think about this. And she goes, I think you were in first grade. And I said, what year was that? She goes, well, actually, you were in first grade for 2 years, not 1. Which was a mildly embarrassing part of the conversation, which is true, by the way. I still can't quite figure that out. But she said, anyway, no, I was 42 years old when I got my first credit card. And the point of that is not that it took me 2 years to get out of first grade, but the point of that is this generation has been spending way beyond their means, and it's just hard to believe we think that's unsustainable at this point in time. So that's one of the structural things we think that keeps the economy from growing very fast. There's some great news relative to M&A drivers, though, and that's what we also want to talk about today. This is the amount of cash that S&P corporations have. And right now it's about $1.6 trillion. It is a record amount of cash. So while governments are overextended and individuals, consumers are overextended, corporate America actually is in great shape. And on top of having a lot of cash, the cost of capital that Drew alluded to earlier is incredibly inexpensive. IBM just issued 3-year notes for 1%, which is a record low. Baker Hughes, closer to home here, issued 30-year notes for 5%. So corporations have a lot of cash, and their access to capital is incredibly cheap, and we think that bodes very well for the M&A market. Relative to the equity market, there is what we call a supply-demand imbalance. So this light blue is the difference between how much capital has been raised to private equity firms and how much has been spent. What you had is you had back-to-back years of record amount raised in 2007 and 2008, and then the private equity groups did not invest money in 2008 and 2009, given the economic turmoil. So today there's actually $400 billion of private equity that has been committed but not invested. And that number will go down because the next couple of years they're not going to raise as much money and they're starting to spend money. So what does this bubble mean for people? They're paying a little bit better valuations. They have to put the money to work. They'll do minority investments, growth investments. They're going to find ways one way or another to make those investments. So if you look at the next page, these funds are 10-year funds and they're 5 years, use it or lose it. So if I invest it within 5 years, I can keep it for another 5. If I don't, I give the difference back. And you can see in 2009, they were on an 11-year pace, which is not going to work with a 5-year fund. This year, the private equity pace has picked up significantly. But even today, if they're on a 5-year pace, most of these funds are already 2 or 3 years old. So the point here is these private equity players, if they don't invest this money in the next 2 to 3 years, they have to give it back to their partners. So lots of corporate cash out there and lots of private equity out there. The next page is really just talks about, in some ways, the proliferation of private equity. When our firm started in 1992, $16 billion was raised that year. The last 10 years, it's been an average of $130 billion. So this has indications of interest for a deal we worked on. The light blue is financial buyers, and the dark blue is strategic buyers. So historically, the strategic buyers would pay more because they have a cheap cost of capital. So if you looked at this, these are 15 indications of interest we got in a deal we worked on 4 years ago. So historically, if you looked at that, the dark blue would all be on the left, and the light blue would all be on the right, because the left is the strategics who have a cheaper cost of capital. There is so much private equity out there and the ability to leverage it. A few years ago, for the first time, financial buyers were actually able to compete with strategic buyers. So you can see at the top 4 buyers we had on this deal, 3 were financial buyers and 1 was a strategic buyer. And that really is a big change relative to 10 or 15 years ago. If you went out to the market, most of the buyers that made sense would be strategic buyers. The private equity buyers just could not compete. And the other thing that is staggering about this, whether you use us or somebody else, it's amazing how everybody's got a different opinion of value. This is a $30 million EBITDA business, very consistent. A lot of it was under contract. And one person thought it was worth $94 million, and the other person thought it was worth $228 million. So most deals we take to the market, you have this wide range of value, and you want to make sure you pick someone on the left and not in the middle. And we did pick the one on the left, by the way.